just how far are venture capitalists willing to go to get a piece of the next hot company? My next guest knows as well as anyone, Michael Kim's Sandana Capital works with the funds investing in early stage companies. These angel investments have become intensely competitive as investors track the meteoric rise of Twitter, Facebook, and others. Before Sandana, Michael worked as an investment banker with Morgan Stanley's M&A unit. He has also spent many years as a venture capitalist with Rustic Canyon Ventures. Great to have you here on Bloomberg West. So first of all, speaking of Twitter, when you hear a valuation of $7 billion for a company that's not making a lot of money yet, is that justified?
The answer, I think, is all about scarcity value. I think whether you're a mutual fund or a venture capital firm or an angel or the average retail investor, scarcity value drives a lot of this. With Twitter being valued at $7 billion reportedly, that would be almost a 50 times revenue multiple. They don't have a lot of revenue, and certainly they don't have profits. Now, if you look at Zynga being valued at $20 billion at its price of that they filed at S1, that's almost a 20 times multiple. And if you look at Google, which is obviously already public, they're trading at about a 6 times revenue multiple. So if you took the Twitter valuation at $7 billion, applied that revenue multiple, then you're suddenly looking at Google being worth $1.4 trillion, and you're looking at Zynga being worth almost $50 billion. And so, you know, whether investors are willing to pay that, that's a market clearing price or not, it's up to it's being driven by scarcity value.
So if you're Twitter and you're having these problems monetizing the product, why not go public now when enthusiasm for tech IPOs is at a high?
Good question. So I think, you know, when I was at Morgan Stanley back in the late 90s, the internet bubble, companies were going public that didn't have revenue, didn't have profits. I think today we're not in that type of bubble where companies that have very strong financials like Zynga are able to command significant valuations. And Twitter is not quite there yet. You know, it used to be that Cisco, for them to go public, they needed 8 quarters of net income. And while we're not necessarily there with today's market, having no income over any quarters won't get you public.
All right, now John Ehrlichman does want to jump in on this conversation. He's been covering this story all week. John?
Thanks, Emily. Michael, I want to ask you about how the venture capital business has changed over the last 20 years. Now it's all about assets under management, because the more money you manage, the bigger fee you get. And that results in a lot of venture capital firms going out, raising more money, and then putting it to work, even if the return isn't as great, because that means bigger fees. Isn't that a concern to you?
Absolutely. You know, the venture market today, I would argue, is not even an asset category. And, you know, I served on the San Francisco Public Pension Fund Board, $16 billion fund. You know, I think part of the problem is that public pension funds got late into the game and wanted to invest in venture firms. And so in the 90s, you saw a lot of the venture firms raise more capital. They are more AUM plays, and historically, the firms that have done well are not doing very well right now. And so it's really a world of have and have-nots.
And to that point, I spoke to somebody today at a company that just got another round of financing, valuing the company at close to $500 million. And he kind of laughed when I talked about how much revenue they're making right now. So I have to ask you about the bubble worry. Do you think there's a bubble out there?
I think valuations of Twitter at $7 billion sort of indicate that, but I invest in seed funds, and I think the top-tier seed funds are still investing in you know, low single-digit million valuations and are showing the discipline in not paying up. And I think entrepreneurs recognize that, and they want to work with the groups that are adding the most value.
Your job is to decide which venture firms are going to have great returns and which aren't. Who are the venture haves and who are the have-nots?
I think you can look at it in 2 ways. You know, the traditional venture firms, clearly Sequoia, Accel, Greylock, Benchmark, Kleiner Perkins, they are able to raise funds at will, and they have put points on the board, significant points on the board. Then you have sort of the emerging funds. Union Square Ventures in New York, for example, Foundry, both of which were in Zynga. And at the stage I look at the seed funds, there are top-tier funds that have have returned significant multiples on their funds, like Mike Maples at Floodgate, Steve Anderson at Baseline. I've invested in a fund called Freestyle, which just had a company sold to Twitter.
You also think some funds are going to cease to exist. Which funds are those?
Sure. So I think in the market right now, the most activity is at the seed stage and also at the growth equity stage. And if you're playing in the middle, if you're a $200 or $300 million fund, you're resting on your laurels from the 90s, you may be able to raise a fund, you may not. And I think there's a lot of those out there that are perceived venerable names on Sand Hill Road that are going to have a tougher time raising capital.
All right, and we do know the venture capital industry has been shrinking. Michael Kim of Sandana Capital, great to have your insights here
Thank you.
on Bloomberg West.